application and the income statement. The way overhead flows through the accounting system ultimately affects the income statement and balance sheet. Let's trace it all the way through. Throughout the year, actual overhead costs are debited to the manufacturing overhead account as they're incurred. This includes rent paid, utilities billed, depreciation recorded, and so on. Simultaneously, overhead is credited out of manufacturing overhead and into work in process as it's applied to jobs using the predetermined overhead rate. At year end, the manufacturing overhead account balance is rarely zero. Actual costs almost never exactly equal applied costs. For Rocky Mountain, suppose actual overhead was $188,000 and applied overhead was $180,000. The manufacturing overhead account has an $8,000 debit balance, underapplied by $8,000. The year-end adjusting entry closes this balance. We'll debit cost of goods sold for $8,000 and credit manufacturing overhead for the same $8,000. This increases cost of goods sold by that $8,000 on the income statement, reducing gross profits and net income accordingly. If overhead had been over-applied, the entry would reduce cost of goods sold. For external reporting, this adjustment is required to ensure the income statement reflects actual costs rather than estimated ones. The balance sheet is similarly affected. Any unadjusted overhead balance in WIP or finished goods must also be considered for a theoretically precise treatment.